क्या my guests are not ready. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then. Dharmesh Kant of India Nivesh and Shahina Mukadam, an independent market expert, join us on the show. Today on Hot Money, we'll discuss which stock among the two is a preferred bet at this point of time. TCS and Infosys, both of them have come out with numbers. As far as the outperformance was concerned, it was clearly Infosys that did well. We talk about Tata Elxsi that saw a big fall in yesterday straight after the first quarter numbers missed estimates. We analyze Yes Bank's reported numbers yesterday where the asset quality saw a sharp deterioration. And lastly, we talk about DCB Bank, what exactly is the analyst saying, what exactly is happening, and is it worth accumulating the stock after the fall. So let's start with the first stock, and that is Infosys and TCS. Before we take our view from the analyst opinion, let's get in Agam Vakil, who's here with some insights on both the stocks. So Agam, what exactly can you tell us about Infosys and TCS at this point of time?
Right, so if you actually consider TCS and Infosys right now, it's just on for factors beyond just the earnings. Infosys has a little bit of an edge considering the kind of announcements that have come through. Now, if you consider TCS and earnings in terms of the way your revenue growth, or for that matter your margins have panned out, it's largely in tandem. Even though TCS revenues were slightly below market expectations, I think we did see a 90 basis points decline in both the companies. But the real takeaway here was the fact that Infosys upped its full year guidance, and it also increased its allocation, the capital allocation policy, to 85% of free cash flows cumulatively over the next 5 years from 70%. And that's the reason why sentiment has improved ever so slightly. So when it actually comes to your valuations, TCS is going in at around 23 times FY20 valuations in comparison to Infosys, which stands at around 21 times. And in terms of analyst ratings, that's a 3.5 again on 5 for TCS against 3.9 for Infosys. So Infosys stands slightly better off as compared to TCS in both these aspects. But in terms of return potential, we hardly see any for TCS or Infosys for that matter, which comes down to around 1 to 4%. But on the whole, just if you on the basis of the announcements made this quarter, Infosys has a slight edge for now.
Okay, that's the view that's coming in on the comparison between TCS and Infosys. Thanks so much for that, Agam. You heard what exactly happened, Dharmesh. TCS numbers were in line, Infosys did slightly better. The counter has also rallied, but TCS has fallen, Infosys has rallied. Now, at this point of time, if someone has to take a bet, don't say 50-50, if he has to choose between Infosys and TCS, which is a better choice?
Definitely TCS is a better choice.
Okay, why?
See, as far as the consistency of numbers is concerned, TCS is still consistent with the numbers. Infosys guidance, they keep on revising every quarter. So my own trust on the Infosys guidance of the growth trajectory is not there, because every time they come out with a new thing, and that is not doing. On an absolute terms, if you look at the INR reported numbers, there has been no growth in Infosys. TCS is still managing a growth, and likely around 20% kind of a growth would be there for FY20 and 21. That is what we are penciling in. Margins has been a concern for both the companies. So, but again, if you look at the margins now, Infosys used to have a better margin. Now TCS is having, even in the downward trajectory, TCS is commanding a margin. I do think that premium valuation for TCS will continue, and this gap which has been created is a good period. You should long TCS and sell Infosys.
Okay, that's the view that's coming in. You agree? Is TCS is a better choice right now for someone to invest than Infosys, or would you go in with Infosys, which declared better numbers?
See, I personally hold TCS, but I think at current valuations, if I was to add or pick up some new stock, I would pick up Infosys.
Okay.
I believe that the numbers and the guidance that they have given is pretty good. They have actually improved the guidance. They have increased the guidance that they have given on multiple fronts, revenue front, on the margin front, and I believe the numbers, the growth that they have shown in this quarter was pretty healthy, despite the problems that are ongoing in Europe and which has affected TCS in terms of the growth. Also, the deal wins that they have had of more than $2.5 billion, I think that is a very healthy sign in terms of the outlook going forward for the year. And finally, the pick is basically both are high quality stocks, so there is no doubt that both are good. But in terms of valuation, I see the gap between the two narrowing. So based on that, I think Infosys at the current level would give you a better return in the shorter term than a TCS.
So Dharmesh had concerns in terms of whether the guidance will be met or no. Historically, what has been your experience with Infosys? Do you think that they vary a lot in terms of guidance? Is that something that they will be able to do?
There have been cases, exceptional cases, when they were going through that bad phase in the last year where they did not meet guidance and the pretty disappointing numbers. But I think to a large extent, with the new management in place and having settled over the last 1 year, I think they would be able to meet the guidance, especially given the fact that they have actually also given a guidance for improvement in EBITDA margins as well as revenue. So the only concern I see there is the attrition rate, which has actually deteriorated in this quarter. Was not really in line with what one would have hoped for. But I think with things stabilizing, they should be able to meet their guidance.
Okay.
I wouldn't really be too negative on that front.
Okay, Dharmesh, what have you told your clients? This was a choice between either of two. But given a choice, what did you tell your clients post the TCS numbers and Infosys numbers? Did you tell them to buy, or are you cautious on this space as such?
See, overall, we are cautious on the space, but I think TCS will be outlier going forward, because any global report you read on the technology space, it's indicating a slowdown, and the spending has been slowing down. So that is reflected in the numbers, not only in Indian companies, even the companies which are listed in the US. But in the basket, if you look at it, and after the jump which TCS has post number, nobody had a chance to buy it. So it was a gap up opening, and 7-8% kind of a gap up is there. Then hardly anything is left on the table to trade on for a company like Infosys. So what we have advised our client, take this opportunity of correction to get back into TCS if you have not. If you are holding, continue holding it. Because still TCS is at 24% of operating margin and Infosys is 20%. So 100 basis points slip from here will bring you a teen kind of a margin, which Infosys never had. So then again, these all hue and cry will start happening. And see, as of now, last 6-7 months, the management has been stable in Infosys. But the change in management is quite frequent. So we don't know again when next thing happens. At least here you have a stable set of things going on. Digital space, if you compare apple to apple, TCS has been doing fairly well compared to Infosys on the digital space, and that is the future. So this is the basic reasons why we are still holding a view on buy on TCS.
Okay, that's the view that's coming in. Just to recap what has happened, Dharmesh is bullish on TCS at this point of time. He's told his clients to start accumulating TCS because of this correction poses an opportunity. And Shahina says at this point of time, given the valuation that we've seen, Infosys makes a better bet than TCS. But personally, I believe you said you own TCS in your...
I do. So I'm positive on both.
Okay, positive on board, but given a choice, yes, Infosys is a better choice from Shahina. Let's move on to Tata Elxsi. The counter did correct 10%. Given the fact that the numbers was much below estimates, it's corrected even in trade today. Remember, Tata Elxsi over the past few months has been correcting. It's not a cheap stock by any sense. Agam, how do you rate the valuations of Tata Elxsi, and what did you make of the numbers that came out yesterday? Just give a brief so that our audience can come in tune with what exactly happened yesterday.
Sure, Darshan. So as you mentioned, it was a very weak quarter for Tata Elxsi, and even while we were expecting some declines, a lot of these numbers were much below expectations, considering we actually saw revenues come off around 5%, a very sharp decline in margins coming in at around 16.5% against well over 26%. Now we must remember that the outlook remains subdued. We also know that Tata Elxsi does design systems for a lot of the automotive sector, JLR being one of its biggest clients. In fact, it has an exposure around 18 to 20% as far as Jaguar Land Rover is concerned. If the outlook remains weak for some of these auto companies, well, the outlook may very well remain weak for Tata Elxsi as well. Now, if you consider the ANR right now, the analyst ratings, we have 3 buys and 4 holds, no sell ratings on Bloomberg consensus. However, if you actually take a look at the price target, a lot of these analysts have actually put the Tata Elxsi under review, which means that we cannot say much about the price target for now. This also means that it may very well be in store for a re-rating. We're going to have to wait and watch out for what price targets these analysts put. But for now, well, sentiment certainly just seems to have turned for the negative.
Okay, Agam, just throwing this into the dark, I don't know, but has the management spoken anything? Have they given any kind of commentary what they expect the next few quarters to be?
No, none whatsoever. And in fact, the management has not put down anything in the press release either, except for the fact that we've actually just seen a decline in revenues year on year.
Okay, thanks so much for that, Agam. Shahina, Tata Elxsi was a big fall that came in yesterday. A while back, it was considered to be a re-rating candidate. Now, certainly, it seems to be a de-rating candidate. What did you make of the numbers, and what should one do?
The numbers, as Agam discussed, were pretty disappointing. And of course, the turnover was lower. The profits were lower, and what is different in this quarter compared to others is that the run rate, which was in terms of profits around 70 crores per quarter, you look at YOY basis, QOQ basis, has now become lesser than 50 crores. And the reason being attributed, at least what I believe, is the problems that are there in Europe, the auto sector and the group company revenue that is coming in from JLR, and the lot of work that is being done for them. So the slowdown in the auto sector is directly impacting them both on revenue as well as profits. So there doesn't seem to be a solution to that problem. And so I think there is going to continue to be some issues regarding profits for the next couple of quarters till the overall situation in Europe stabilizes. So that is a big negative. Secondly, I think valuations are expensive. It was one and remains one of the most expensive in the smaller IT stocks, and it was getting the premium valuation because of its management pedigree and of course the consistent type of numbers that they were reporting. So I think that has come into question. So I see in the shorter term the stock still correcting a bit.
Okay, there could be more correction. Dharmesh, you don't track Tata Elxsi. Would you want any comment? I know you don't track it officially, but do you have anything to say, or should we move on to the next stock?
Move on to the next.
Okay, so that's the view that's coming in on Tata Elxsi. Shahina says that there could be more potential downside. Now the next stock is interesting, and probably it's been the stock of the day and probably stock of this year itself, and that's Yes Bank. Before we get in our analyst comments on Yes Bank, Shefali is here and to tell us the 5 key things about Yes Bank result. What did the management say? So Shefali, what did you make of the numbers? Clearly the numbers did manage to miss the estimates, but clearly it was a shocker, right?
Yes, absolutely, because the street was expecting that whatever cleanup that the bank has done, that is already being factored in, and whatever may come in the numbers that also may meet the expectations, but that didn't happen. There was further build-up in the NPAs, which was below expectations. So what they actually did in the quarter was their gross NPAs on absolute number, they went up by about 53%, and in percentage terms came in at about 5.01% versus 3.22 on a sequential basis. And gross slippages of 6,200 crores almost doubled from what they did in Q4. An important point to note here was that out of the gross slippages of 6,200 crores, 2,500 crores came in from the watch list that the management had guided for. That is a watch list of 10,000 crores. And after these slippages as well, again the management is saying the watch list continues to be 10,000 crores again. And more importantly, their CET1 came in at about 8%, which is just the regulatory requirement. And according to a brokerage firm Credit Suisse, they are saying that even if they raise $1 billion, which the management has been saying, the CET ratio will just go up to the capital ratio will just go up to about 9%, which is by March 20. So that will not be enough for them to meet their requirements going forward. So that is one key point in their earnings. And also another important point, the credit cost guidance that they have been giving of about 125 basis point, that does not include MTM on the investment provisions. So considering the downgrades that we have been seeing in the last couple of months, the investment portfolio also needs to be watched out for, and hence the credit cost or the overall provisioning that the bank makes going forward may be much higher, weighing down on the earnings going forward as well.
Okay, thanks so much for that, Shefali. Yes Bank. Dharmesh, were you surprised with the numbers? I think if you see what exactly has happened, I think every analyst on the street except for one or two got this wrong. Everyone had targets of 250, 300 on the bank, and now they're revising it from levels of 250, 300 right to 50. So I think most of them got it right. Were you surprised with what exactly is happening quarter on quarter, that they're not able to clean up their books?
No, not at all. So the type of exposure they are having to the groups, so this was about to come. I am surprised because they are delaying the provisioning process. They should have been more faster and more forthcoming. Because it doesn't help. You are coming every 10-15 days on the media and you are guiding something, and then again when your numbers come, it again deviates from what your earlier guidance was, and in such a short span of time. So being a bank and such a large bank, so around 2.5 lakh crores of advances they are having. So this doesn't help the case. So what we did was a back of the envelope kind of a calculation.
Okay.
So rather than tracking how much more NPA would be provided, so 7,000 odd crores of around net NPA standing on the books, which is still to be provided for. Our calculation suggests that this can go to 15,000 odd crores of write-off completely. Nothing gets recovered. So that means 24,000 odd crores of net worth they are standing on. So more than 60% goes away. So 114 is the book value as of now. If it comes down to 54, 55. If you do it right today, and they have an earning potential of around 18 to 20 rupees book value on the current business for per annum. So 50 rupees now, 23 years it is 60 rupees. So 110 you are back to after 3 years time frame with the steady state business which they are having. Yeah, capital would be a requirement to meet further growth opportunity. So to that extent it is still expensive. 1.3, 1.4 is price to book. But if you look at this bank from, say, compare it with the public sector bank, Canara Bank or Bank of India, any bank you pick up, PNB, Bank of Baroda, then you will find comfort in Yes Bank. Because what they are missing is on the retail growth opportunity. They still clock 48% kind of a retail growth. So what I like about Yes Bank is management focus to carry on the business. The business which they are getting, they are very aggressive on that. 600 odd employees they have taken, and they have taken employees at a higher cost. They have given hikes. So there they are not, any kind of compromises not being there. So if you value that way, so I don't know where the bottom will be, because one more quarter has to go, some other provisioning comes, and it will definitely come. So that may again push the stock prices downward. A floor can be provided by the QIP if they do by say next month, which they have guided. So that would be the first floor price for the Yes Bank. But yeah, if somebody is holding a view of 3 years, so my own sense is it's a multi-bagger. Like if 110 rupees kind of book value happens, it may be a faster. If my estimate goes wrong and the recovery is faster, it may be much more than that. So 200, 250 based on FY21 numbers is a likely target. I'm on the other side.
So you are saying you should start accumulating for a longer term perspective.
Yes.
Don't look at short term opportunities or losses or whatever comes in Yes Bank. That's your view.
Correct.
And you believe that this management will be able to clean up the books, not next quarter, but over the next few quarters you think it is, or will it go? See, because the point is, if you compare it with PSU banks, there is no fear of going concern because the government backing is there. Now for a Yes Bank, there's no government backing. They can't let a bank fail this way, but you've seen what's happened with Dewan also. You've seen what happened with this thing, some of the private sector. So is that concern there on the back of your mind?
No, I don't think Yes Bank is into such a grave situation that going concern basis can be questioned. So they have a huge deposit base, and see, government Dewan Housing is a different. Dewan Housing doesn't attract deposits from the public. They are standing on a deposit of 2.5 lakh crores. So if this goes burst, it will be a run on the entire system, banking system. So, but I don't see that happening with Yes Bank. So if that would have been the scenario, then the type of business they are continuing, the type of aggression they are showing on the retail side and SME side would not have been there.
Okay. Shahina, you agree should be accumulated low level, or you have a different view?
I totally agree with what Dharmesh is saying, that one should definitely accumulate it at current levels. If one is holding it for some time, you're definitely disappointed the way things have panned out. But let us look at the positives and negatives. One is, of course, in provisions, if you're talking about specifically, they have provided 3 times the provisions that they have done in the past. So I think they have done as much as they could in this quarter. going forward, they already have provisions of about 25% of the book for real estate, which is around 20,000 crores. Now that is a positive also and a negative also. Positive one, because 25% is provided for, and it is hopeful that some of those accounts will become, go clean, and things will get cleaned out in the next quarter or two. If that happens, then you can really see a big spurt. If that doesn't happen, and a lot of more provision needs to come on the real estate book, one really doesn't know at current point in time, then that is a big negative. So it can go either ways. And the last is, of course, the issue that is being planned, the FPO that is being planned, preference or whatever, fundraising plan of about 7,000 crores that is being planned in this quarter. So if that goes through, definitely growth will come back in terms of loan growth, which has been decent actually. I'm not saying it has been good, but it was in lines of expected lines. If that goes through, because it's a big percentage of the net worth, so that is a positive. That could be the bottom, I totally agree. So I would be accumulating at current levels, but in my view it still remains a high risk bet. I'm neutral largely, unless you're a risk taker.
Okay, that's the view that's coming in on Yes Bank. Both of our guests do agree with similar points that, for a long-term perspective, yes, the bank should be accumulated. Short-term, don't look at it. So that's the view that our guests have given. The last stock on the list is DCB Bank, and it's actually fallen significantly. If you see what happened, it was trading at levels of 200 when they came out with the fourth quarter numbers. It went all the way to 240, and all that was wiped out within a matter of one and a half days. So all the gains that they did in one quarter was wiped off in a single day because of a bad quarter. Shefali, was it such a bad quarter that such a price fall was warranted?
Well, yes, it was indeed a very bad quarter coming in from DCB, especially considering the fact that the stock price had risen so much and the expectations were very high from this. It was trading at valuations of about 2.2 times. And so considering those valuations and the kind of performance that has been put out by the bank, the fall was warranted. So what they did in Q1, operationally the numbers were below expectations and the asset quality too was disappointing. And it holds all the more importance because they do have a significant exposure in the SME segment. So that segment as well threw some negative surprises. And other than that, the numbers were largely disappointing, mainly because of the lower fee income, margin pressure and muted loan growth. Their gross NPAs as well surged by about 9% on a sequential basis, and slippages were at a run rate of about 2.5% versus 2% that we saw in the preceding 6 quarters. The management going forward guided that the margins will continue to remain under pressure over the next 2 quarters as well.
Okay, thanks for that, Shefali. Shahina, concerned with what happened with DCB Bank, was it a shocker to you?
I think it was a disappointment. I wouldn't say it's a shocker because all the banks have been reporting disappointing numbers. At the same time, I think in terms of provisions, while their provisions have gone up, their slippages have gone up, so that is a negative. But if you look at the loan book, about 90% of it is secured. So to that extent, I do see that this is a better managed portfolio vis-a-vis others. Also, the ticket size of the bank is smaller, so it's more in agri, CVs. So there the delinquencies are lesser. It's like it doesn't have that much exposure to large corporates, where large account or real estate, where large corporates and real estate is going belly up. So to that extent, it is protected. I think the gross NPAs, while have slipped, are much better than most of the other numbers that we are seeing as of now. So and in terms of valuation, while 2.2 going up to 2.5 is disappointing in terms of price to book, I see this as an opportunity to keep adding. And with the promoter holding about slightly lesser than 15%, I see this is a good bank for any M&A or whatever activity that can happen in private sector. DCB is well up there, as well as being one of the better managed smaller banks. So I would take this opportunity to add, despite the numbers being disappointing.
Okay, add is something that Shahina says. What's your sense? Should someone buy DCB Bank after the numbers that came out? Is it a good opportunity now?
So this is the vulnerability of small banks. So any bank which is smaller in size, they particularly thrive, and particularly DCBs, federal banks of the world, they thrive on small businesses, be it CV business, be it retail business, even SMEs which are small scale SMEs. So and they have a limited strategy of attacking the business. They have been able to turn around the business quite well. I mean, 10 years back, DCB was in a horrible state of affairs. That they have turned around. But if your business size is small, your balance sheet size is small, and you want to attract a premium valuation, market never gives you that. So there is no free lunches so far. So what, to my mind, if you are growing in lower teens or mid teens, you cannot have a price to book value of more than 2. So it will be 1.7, 1.8. So where it is as of now, it is being placed there. So I don't think
it's expensive for you.
Yeah, it's expensive for me, definitely.
And you see them taking market share from the other private sector banks or PSU banks when everyone else is getting aggressive?
No, they are very conservative in their approach. They have a different method of lending business, DCB in particular, and the broader economy is slowing down. So any data you look at, be it auto sales, be it CV sales, be it retail sales, be it FMCG, so the slowdown is there, and these are the banks which are badly first hurt by the slowdown. So I don't see a case immediately, at least for a couple of quarters, where you should be acclimating.
Okay, so that's the view that's coming in on the final stock. DCB Bank, Shahina says that at lower levels this should be accumulated. Stay away is something that Dharmesh is talking about for DCB Bank, but the counter is down almost 3%. Before we end, Colgate came out with the numbers, strong set of numbers, volume growth of 4%, in line with what was anticipated. The counter had corrected over the past few days on anticipation of weak set of numbers, and that's why a 3.5% up move on Colgate. Pure short covering could be possible on Colgate, even though the net profit is down in trade. But overall, it seems that the market has rewarded Colgate for coming. Yes, revenue growth is clearly there, 4% growth. So that's on Colgate. But with that, it's a wrap on today's edition of Hot Money. Let me take this opportunity to thank both of my guests, Dharmesh and Shahina, for coming in today for the show. Ask BQ comes up next. Stay tuned to Bloomberg Quint.